Hey, it's Noel Mathias from Mortgage360, and today we have some updated news with respect to the Bank of Canada. Well, not necessarily interest rate news, but what's expected to happen in the economy news. But before we get into it, and you're probably getting tired of me saying this, but before we get into it, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button for the YouTube algorithm. It does me a huge favor. So thank you for those of you who are doing that. Okay, so let's get into it. The Bank of Canada did what was widely expected. They did not increase interest rates today. They did not lower interest rates today. They left interest rates exactly where they are. It was the obvious move, and what that does is it leaves your interest rates at pretty much the same rate today as they were yesterday, especially for those of you who are on a variable rate. But that being said, the forward guidance was interesting. That's the story from today, and that's what we're going to talk about and how it's going to affect interest rates over the next 2 to 3 years. So what exactly was the guidance today? Well, it was specifically that they expect interest rates to remain the same till 2023. Now, this is new because back in July, when they talked about interest rates remaining low for 2 to 3 years, and we were able to assume that that meant 2 to 3 years, and specifically 2023 because of what their research looked like. Well, today they came out and said full on 2023, that's when you can expect interest rates to maybe start going up. And that's based on a few things. So the first thing that they're basing that on is the fact that they're going to expect GDP to grow at an increased rate in 2021 and 2022. In fact, they expect it to increase at a higher rate than any other time since 2007. That's a big deal. And why do they expect it to increase at a higher rate than any time since 2007? Well, it's because we're going to have all of this slack in the economy, all of this available resources, people resources that are going to be able to come online and hopefully increase consumption at a really high rate. And what that's hopefully going to do is push inflation up to around that 2% target. And then once they're at 2% for a sustained period of time, so they don't just want to hit 2% inflation and then pull back all the resources that they've applied to getting it to 2% inflation. What they're going to want to do is they're going to want to make sure that they can stay at 2% inflation for an extended period of time. I'm guessing that's probably in the 6-month to a year period before they actually start increasing rates, which puts us into mid-2023 before increasing rates are even a possibility. The second thing that's based on is that we probably aren't going to see a vaccine until mid-2021, which means that it's going to take into 2022 and 2023 to get everybody vaccinated and get things rolling at the same rates that they were pre-pandemic. Now, there's some other interesting points in the Bank of Canada's forecast today. The Bank of Canada has slowed down its Canada mortgage bond purchases, which is a good sign because back in April and May, they were buying large amounts of Canada mortgage bonds in order to maintain liquidity in the market. So in other words, to make sure that there was still enough money there to be able to lend to mortgage consumers in Canada. And what it means that they're no longer needing to do this is that the mortgage market has improved. So this isn't going to lower rates or increase interest rates. It's really a non-issue for people who are borrowing. But what it means is that the mortgage market has stabilized, which is good news for the long term. It means that something like the liquidity crisis of 2008, 2009 is not something that we really have to worry about at this time because there's enough liquidity in the market to support all the new mortgages that are being approved across Canada. That's a good thing. They've also reiterated that they're committed to quantitative easing, which means as the economy needs more money injected into it, they're going to be there to make sure that the money is injected and that people are going to be able to manage their way through. And what that's really important for is for government spending and the incentive programs that are out there and the fact that they're going to be able to fully fund those via the Bank of Canada. And this isn't something that we really need to worry about as Canadians because all the banks worldwide are running similar programs. So it's not like Canada is out there spending all this money, printing all this money, and everybody else isn't, and we have to worry about our dollar fluctuating and crashing and all of that stuff. No, the whole world's in the same sort of situation. So what the Bank of Canada is doing is very much relative to what is happening in the rest of the world. Now, they are expecting the recovery phase to take a little bit longer than expected, and that's to be expected. Like, nobody really knew how long this was going to take at the beginning. Everybody was making their best guess when it came to trying to predict how long the pandemic would affect the economy, and what they realized is that it's probably going to take a little bit longer to recover than what they expected. The industries that are most affected seem to be food, travel, recreation, arts, things that aren't necessarily necessities, although I know myself, I think travel is a necessity. I think food and restaurants are a necessity, but not things that, ultimately will grind the economy to a halt. Now, unfortunately, most of the jobs that have been lost, Most of the people that are suffering are in the lower income bracket. But what's interesting is the resiliency in the middle class income bracket and how that has managed to stay fairly steady throughout the course of the pandemic. And that's why you're seeing increases to housing prices, and you're seeing, low rates, increased borrowing, and people moving to bigger houses with bigger yards and where they aren't as crammed in with their family members as they once were. If I was an investor right now, I'd definitely be looking to the lumber industry. I'd be looking to housing and roofing and anything to do with housing people in the suburbs. Any stocks related to that are probably going to perform well over the next year or two. I definitely would steer clear of anything commercial real estate related, because there's been this shift, obviously, from people working downtown and working in offices to working out of their homes. And that's why you're seeing corporate vacancies increase, but you're seeing people still want to move to bigger houses than what they already own. What's really interesting about the housing market is the housing market continues to thrive regardless of what's happening. And when the whole pandemic started back in March and April, we saw housing sales go basically to the floor, almost to zero. There was very, very, very little activity. And throughout July, August, and September being a huge month, basically everything has rebounded back to normal levels. In fact, that July, August, September activity has pretty much made up for all the lost activity prior to that in those months where everybody was on lockdown. So, the housing market is continuing to be a shining light in the economy, because as long as people are buying houses and moving, there's going to be construction jobs, there's going to be jobs in finance, there's going to be jobs surrounding those industries, real estate, that type of thing. And that's a good thing for the economy. Combined with low interest rates, that makes it a really good time to get into the market. And it's going to be 2 or 3 years before we start to see those rates increase, because the economy's picked back up. And at least right now, we know that if we're buying, we can take advantage of the low rates. We can extend our runway of low rates by taking a variable for the next 2 or 3 years and then locking in as interest rates start to go up, giving us 8, 9 years at a low rate instead of only 5 years at a low rate. And by having that low rate for a longer period of time at the beginning of the mortgage, we're actually going to be lowering our overall costs, because most of the cost when it comes to buying a house, at least half of it, has to do more with interest than the actual price you pay for the property at the beginning. So we'll keep keeping you updated on what goes on with the Bank of Canada and what goes on with interest rates. Next video will likely be Bank of Canada and interest rates explained video, so you can understand exactly what we're talking about when we talk about what the Bank of Canada is doing. And for the meantime, do me that favor, hit the subscribe button, hit the notification bell, and hit that like button for the YouTube algorithm. I appreciate you. Thanks.